In 5 years, Costa Coffee went from 4% annual sales growth and £100 million in profits to flat revenues, £13 million in losses, and a 5% drop in market share. After refocusing its strategy on self-serve machines, ready-to-drink products and global brand licensing, Costa lost ground to both direct competitors like Starbucks and Pret, as well as to independent cafes like Blank Street and Watchhouse. So how did Costa go from a category leader in the UK-branded coffee shop market to a brand that struggles to turn a profit? In this video, we analyse how overexpansion, misplaced strategy, and market bifurcation drove the decline of Costa Coffee. For 2 decades, Costa Coffee dominated the UK coffee market. Backed by Whitbread, owners of Premier Inn, it expanded aggressively across high streets, transport hubs and office districts, building massive scale and becoming the default coffee choice for millions of Britons. By the late 2000s, Costa controlled roughly a quarter of the UK-branded coffee market and generated strong, reliable profits. That dominance made it an attractive acquisition target, and it was eventually sold for £3.9 billion to Coca-Cola in 2019. Since then, however, a combination of overexpansion, misplaced strategy, and market bifurcation has accelerated the decline of the coffee chain. By 2019, Costa Coffee had saturated the UK. Thousands of stores covered almost every conceivable location, from high streets, retail parks and hospitals, to petrol stations, transport hubs, and office districts. That density once gave Costa an unbeatable advantage. Wherever you were, there was a Costa nearby. But after 2019, that same scale became a liability. Costa entered the post-pandemic world with one of the largest fixed-cost store estates in the UK hospitality industry. Long leases signed years earlier assumed stable footfall, 5-day office weeks, and predictable commuter flows. However, those assumptions no longer held after 2019, as hybrid work reduced weekday demand permanently and high street footfall weakened. Meanwhile, inflation pushed rents, wages, energy costs and business rates higher. Unlike independents or smaller chains, Costa couldn't easily exit these sites without taking write-downs or renegotiating leases from a position of weakness. Effectively, its scale became a major drag on its financial performance. After Coca-Cola acquired Costa in 2019, it refocused the coffee chain's strategy on 3 areas: Costa Express self-serve machines, ready-to-drink bottled coffee, and global brand licensing. On paper, this made sense. Costa Express machines generate steady returns with minimal staffing. Bottled coffee plugs neatly into Coca-Cola's global distribution system. Licensing allows international expansion without operational complexity. But this shift had consequences in the UK market. As attention, investment, and management focus moved elsewhere, Costa's café estate became less central to the brand's future. Store formats aged. Refurbishments were incremental rather than transformative. The café experience stopped evolving at the pace of the market. Over time, this changed how consumers perceived Costa. The brand became less associated with a specific place or experience, and more with a logo that appeared across many formats. That ubiquity came at the cost of distinctiveness and ultimately eroded its pricing power and customer loyalty. Since 2019, the UK coffee market appears to have split. At one end, premium and experiential coffee surged, independent cafes and boutique chains gained share by offering better interiors, stronger identity, and higher perceived quality. Brands like Watchhouse and Grind reshaped consumer expectations. Coffee became part of lifestyle and identity, not just routine. At the other end, value players thrived. Supermarkets, Greggs, McDonald's, and convenience stores normalised low-priced, acceptable coffee. However, Costa sat between these two forces. It wasn't premium enough to justify consistently higher prices or command aspiration, but it wasn't cheap enough to win value-driven customers either. Effectively, Costa tried to defend a broad middle market position that was steadily shrinking. As the market polarised, Costa's relative share declined as consumers increasingly chose brands with clearer propositions. Costa's decline isn't irreversible, but recovery would require hard trade-offs. The brand would need to shrink and refocus its café estate, invest meaningfully in store experience, and choose a clearer position in the market rather than defending the middle. That means deciding whether Costa wants to be genuinely premium or unapologetically convenient. While machines and bottled coffee can generate cash, cafes still define the brand. Without fixing that core tension, Costa risks remaining large, but increasingly irrelevant.